If you're financing a commercial real estate deal with debt, one of the most important decisions you'll make is whether to go with a fixed rate loan or a floating rate loan. And while this might seem like a pretty small decision in the grand scheme of things, this can have a huge impact on the performance of a deal, and this has been one of the main catalysts behind the distress we've seen in this industry over the last few years. So to make sure you know what to look out for when choosing between these two options, in this video we'll break down the main things you need to know about both floating and fixed rate loans, and both when and why it might make sense to use each of these. So to start with fixed rate loans first, these loans will have the same interest rate throughout the entire term of the loan, and whatever rate you lock in at the time of closing is what you'll continue to pay until that loan matures. Fixed rate loans are great options for investors who believe that interest rates will rise over the loan term, but these are also great options for investors who consider themselves a little bit risk averse and are willing to sacrifice maximizing returns for the sake of capping their downside. Fixed rate loans give a borrower certainty about their monthly debt service obligations regardless of where interest rates go during the loan term, which is often a preferable option for investors acquiring stabilized assets with a long-term hold horizon with a primary goal to generate predictable monthly income on a regular basis. And as far as how interest rates are determined on these loans, fixed rate loans in the US are typically priced based on the equivalent term US Treasury yield plus an additional spread above that, which means that a 5-year fixed rate loan would be priced based on the 5-year US Treasury yield plus an additional yield to the lender, usually coming in at somewhere between about 150 to 250 basis points to make up the all-in rate. Now, the main issue with fixed rate loans is that these can be really inflexible when it comes to paying these loans off early and include either major prepayment penalties if the loan is paid before the maturity date, or even in some cases, entire lockout periods where the loan can't be prepaid at all. These things can make it really difficult, or in some cases even impossible, to sell or refinance more than about a year before the loan is scheduled to mature, which can create serious issues if the borrower wants to take advantage of peak market pricing during that loan term or significantly lower interest rates that could materially increase cash flow. But even with the downside of inflexibility in most cases, fixed rate loans can be great options for investors who plan to hold their properties for a long period of time, and especially investors that are looking for certainty in their loan payments throughout the entire loan term. Now, on the other side of the spectrum, we have floating rate loans, and these loans have an interest rate that's variable throughout the loan term, and this interest rate is typically going to end up changing on a monthly basis. These types of loans tend to be great options for investors with a high risk tolerance who believe that interest rates will fall over the loan term, and these are also great options for investors who need to maximize prepayment flexibility for shorter term hold periods. Unlike fixed rate loans, most floating rate loans don't come with major prepayment penalties, which makes these really popular options for major renovation projects, ground up development projects, or any scenario where an investor plans to sell or refinance in just a few years. And as far as interest rates are concerned, floating rates in the US are typically priced based on the 1-month term secured overnight financing rate, or SOFR, with this index rate resetting on a monthly basis, plus again a spread for the lender of anywhere from between about 250 and 450 basis points depending on the deal. This means that if the 1-month SOFR is sitting at 5% at the time of closing and your spread is 300 basis points on that loan, your all-in interest rate to start would be 8%, but if the 1-month SOFR drops to 2% 2 years from now, that all-in interest rate at that time would drop to just 5%. Now, even though investors using floating rate loans are typically willing to take on more risk, they'll also often take steps to proactively protect against a major downside scenario, and this is where what are referred to as interest rate caps start to come into play. An interest rate cap is essentially an insurance policy on a loan where a borrower pays an upfront fee to a third party, and in exchange for that fee, the rate cap provider will pay any overages in monthly debt service if rates end up going above what's referred to as a strike rate. The strike rate represents the maximum interest rate that a borrower is responsible for, even if rates go above this amount, which means that on an interest-only $1 million loan with a floating interest rate priced at 1 month SOFR plus 300 basis points and a rate cap with a strike rate of 6%, even if SOFR ends up jumping to 9% during that term, the borrower would only be responsible for that first $7,500 per month in total debt service, and the cap provider would have to step in and reimburse the borrower for that remaining $2,500 per month. Now, just like any other insurance product, these caps aren't free, and a few different things can end up impacting the cost of these in the market. The first thing is the strike rate itself, and in general, a cap with a lower strike rate will be more expensive than a cap with a higher strike rate, all else being equal, since a lower strike rate will increase the likelihood that a cap provider will ultimately have to pay at some point throughout the term. And the second thing that impacts cap pricing is what's referred to as the notional, which is essentially the loan amount the cap applies to, with a higher notional being more expensive than a lower notional, since this ultimately results in more monthly debt service that the cap provider might be responsible for. And on top of both of these things, the term of the cap, or how long the cap applies, will also impact pricing, with a longer term being more expensive than a shorter term, and volatility in the capital markets can also play a huge role here, with more volatility in interest rates resulting in more expensive caps and vice versa. Now, if you're curious as to exactly how much these caps might cost, pricing can vary a lot based on the factors I just mentioned, but if you want to see what these might look like in a variety of different scenarios, companies like Chatham Financial and Pensford both have really helpful free interest rate cap calculators that are available on their websites, and I'll link both of these in the description below in case you want to take a look. And in addition to interest rate caps, just like borrowers will try to protect their downside, lenders will also try to protect their own downside through what are referred to as interest rate floors, which set a minimum interest rate on a loan even if the index rate ends up falling beneath that. Ultimately, floating rate loans are really complex financial instruments that have a lot of moving pieces and tend to be best for short-term hold periods where investors need to maximize prepayment flexibility and feel confident that rates will stay steady or even fall throughout that loan term. All of these things need to be considered when choosing between these two financing options, and in most cases, investors will also run both of these through a detailed financial model to see the impacts of each scenario on projected cash flows and returns. And if you want to learn more about how to incorporate both fixed and floating rate debt into a real estate pro forma, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on commercial real estate loans, make sure to hit the like button and let me know. And let me know in the comments if there are any other loan products or terms that you'd like to see covered in a future video. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.